Assalamu alaikum, Hamas Abdul here, and in this video we will be talking about business transaction. Overall, the chapter number one of Kaplan FA1 book. So, in this video we will be talking about the issue of business transactions. You know, businesses are there in order to perform across industries, and they are making transactions. So, introduction to business transaction. Okay. In this video, we will be talking about its definitions, its examples, and importance of recording. What are it? Business transactions are the activities of selling goods, services, buying goods, services, paying employees, and incurring expenses. Every transaction must be recorded to ensure business success and financial accuracy. So, what are transactions? Transactions like for a supermarket, these are like selling goods to the customers or buying from the wholesale in order to resell it for the customers. So, what's the definition? It's by self, an activity of selling or buying, even paying employees, incurring expenses. So, these are all come in the category of transactions. What are its examples? Retail stores like supermarkets, garages where they are providing services in order to fix your cars or something like that. And offices all engage in daily business transactions. So importance. Why it's important to record it? Recording transactions ensures accuracy, resolve disputes, and support business success. So, when you record these transactions, their effects in the financial performance of the organization can be identified. So types of business transactions. There are numerous transactions, ideally in each businesses. So it starts from the main activities of selling goods or services. Business are there to make a profit, so they're making it through sales, either provision of goods or provision of services. Maybe they sell goods or services to customers in exchange for money or credit. Buying from suppliers. So, in order to sell or provide a service, they need by themselves to purchase goods. Like suppose you are creating furniture and you are performing in this industry, so you need, in order to create that furniture, that chair or table, you need resources, you need raw materials like metal, like wood. So by yourself, you are buying it from suppliers. That results in another form of business transactions. Paying employees. So employees are there to work for you, so their payment or their salaries or wages, these are also resulting in a transaction. Incurring expenses. You know, in order to live, we ourselves, human beings, we are making cost of living. We either uh, in the home we live, we pay the rent or living expenses. Ideally, the companies are also there, and they are making, in order to survive, they are making expenses. Either they uh, for their needs of services like the factory rents, uh, other raw material purchases. So these are making expenses in order to survive. So we studied that there are numerous types of transactions, and now from a view of payment, there are also two types of transaction. One is the cash transaction, and the other is the credit transaction. So what's cash transaction? Suppose you are going to a supermarket and you buy a coffee and you pay that 10 penny or the amount that uh, you are giving it. It's a cash transaction. He provides you with the coffee, he provides you with the goods, and you provide him with the consideration. You provide him with the money, so with the cash. And it's an immediate transaction. He gives you the coffee, you gives him the money. So this is a cash transaction. And the second term is the credit transaction. Credit transaction means suppose you're in the furniture industry and in order to produce you need a machinery. You go to the supplier and you say, provide me the machinery now. I will pay you in 2 months. So you takes the You take the machinery now, you take the goods now, but you pay in a later date. So it's resulting in a credit transaction. It's not an immediate one. So cash transactions, payment made immediately using notes, coins, debit or credit cards, or checks. Uh, it's not just the cash that you give. Either on any types of payment that you pay immediately through it results in a cash transaction. Either you may go electronically pay them through debit or credit card you have. Credit transactions, payment deferred over a credit period agreed between buyer and seller. As in the previous example, the supplier agreed that he will take the payment 2 months later, but he will provide you with the machinery on today or every date it is. There we have an example. Velocity Books publishers order books on credit from QPrint. QPrint delivers the books and send an invoice. Velocity pays within the agreed credit period. This is a credit transaction. No, uh, this example and its details are in the Kaplan book. So it's better that you go there and after you watch this video, go there and revise that Kaplan book for good concept clearance and better concept. So here what it is, a book publishers these gets an order or something like an author here comes there and wants its book to be published. So the publishers goes to the printers and told them that they need 5,000 prints of this, and the printer agrees to print the book on 1st of March, as I think, on 1st of March. But the payment is made at at a later date, at 60 days, on 1st of May. So this results in a credit transaction. So now we have discussed about transactions, its types, uh, according to different things, according to the payments. So now we're coming to a really important area, key terminology in business transactions. You know, there are terminologies in each of area. Like if you are studying medicine, there will be a lot of terminologies specifically to that area, and accounting is not an exception to that. Accounting has its own terminologies or terms that are frequently used either in your accounting studies and or either in this book or your further studies. So let's see. Sales. Sales and purchases. Sales includes exchange of goods or services for money. So this results in sales. You either sell a product or you provide services, and in exchange you get money. So this results in sale. And it's also include commission and fees. So sometimes you offer services like you offer tuition and in exchange you receive fees. So it's an interchangeable words. Purchases involves buying goods for resale or consumption used in the business. Purchases include either you buy something for resale, you're a retailer and you buy from wholesale some items and you resell that, so it's included in the purchase. Or either you buy those products or services for consumption in the business, like electricity. Receipts and payments. Receipts, these words are commonly used in our daily life also. Receipts means you receive money. So, what it is? Receipts means all money received by the business, not only from cash sales. So receipts are not those that you're just your cash transactions. It's also included those credit transaction, like you have an account receivable from one of your customers and he pays you, so it's a receipt for you and it really is included in the receipt section. Payments means all money paid out by the business suppliers or others. Payments means that in order you buy something on cash or a credit from suppliers and you go and pay them. Income and expenses. Income is broader than sale, includes rent received and interest earned. We discuss sell. It's a exchange of goods or services for money. But what is income? It's a broader term. It's a bigger term. It really includes sales and also includes other types of income that you may receive. Here, an example is rent received. Expenses. These are costs incurred, including goods for resale. You know, in order to act or perform in an industry, you need a place to work in it. So you need a factory, and you go to rent that. So it's resulting in an expense. An expense does not include goods bought for resale, like your products that you are buying from wholesaler in order to sell it to the retail section. Petty cash expense. PT cash. Now look at PT and look at this visual. This is a box of money and it includes notes and coins and what for it's held. This is a let's read the description. Small cash for small business expenses. Uses coffee, stamps, taxi fares, travel costs, and flowers for sick employees. So now, petty cash is a small amount of money, a small amount of cash held for business in order to meet small expenses. Small expenses can be what? Coffee. An employee is somehow tired and he goes buy some coffee with biscuits. So he takes the money from not the business bank account. He takes it from the petty cash. Ah, other types of expenses can be taxi fares that an employee want to go on a business trip or a travel cost, flowers for sick employees. Like one of your employees sick and and the other day he comes and you give them a flower. So the cost of these are met through petty cash, a small amount of cash held for small expenses. What are responsibilities toward petty cash. Managed by a petty cash custodian or teleoperator, benefits simplify small payments and make cash reconciliation easier. So the benefit of petty cash is that it simplifies small payments. There is a really simple method. You go out and you get a voucher and you bring out the supporting documents. So it really is. Payroll in the business. Well, payroll by itself somehow means a list of employees who work with the business. But here, payroll is now is concerned with the activities of the payroll department in a business. You may heard of it. So managing employee payments accurately. The main and the broad purpose of payroll department is that they manage the employee payments accurately. There is two words. One is wages and the other is salaries. There is a difference between them. Wages are normally called to those employees who work with us on a weekly basis and they are get paid on a weekly basis. And salaries are like those employees who gets monthly or annual salary. So there is just a small difference between them. Payment methods. How we are going to pay our employees. So we may go either pay them by cash, by check, by bank transfer, or by bank automatic clearing system. So there are different methods. Cash, you're uh, familiar with cash. Uh, Payment in notes and coins. Check, you may also heard of check. It's a document more safer. There is less risk of theft and fraud with checks. So now the payroll department is responsible for paying employees accurately and on time. It also handles payments to outside agencies such as tax authorities and pension providers, ensuring all deductions and contributions are correctly processed. So payroll department is not only responsible for paying the employees their wages and salaries, they are also responsible for paying the other outside agencies like tax of the businesses on the sales or and also the pension on employees schemes that they have created, either the employer has created or they by themselves. Keeping a record of transaction. Why accurate records are essential for every business? So, you know, accounting is all concerned with keeping records. So, why it's important to keep record? There are numerous reasons. Firstly, to resolve disputes, settle queries in disagreement using documented transaction evidence. It acts as a proof. Like, let me give you an example. Suppose one of your customers has ordered hundreds of, you're operating in a stationery area, and he has ordered 100 books, and you process that order and you provide him with that 100 books and you send an invoice. But he comes and says that I only ordered 50. Now, if you have that order, that the original order, now it can act as an evidence that you were right and there was 100 invoices, 100 amount of order. So track amounts. Now, if you have evidence, if you have a record of your transaction, you know how much you are owed to suppliers and how much you are owning from your customers. So it means how much, in simple terms, how much you are payable to your suppliers in respects of goods or services that you purchase, or how much you are receivable from customers that you have provided them with the goods or services. Prevent theft. So verify honesty or stuff and detect fraud through accurate record keeping. So there may be some dishonest stuff and they are likely to uh, benefit un, uh, un, uh, unhonestly from this way. So records are also useful for double entry. What's double entry? What's this system? It's a system for recording transactions, and we will further study it in chapter number 3. Key personnel in their roles. Wow, who handles transactions across different business sizes? So now, key personnel are those personnel who are responsible in their departments. Like, suppose what? The key personnel in sales departments are those clerks, are those sales managers. But while in the purchases departments, they are those orderers and uh, purchase managers. So there is every department has its own key personnel. Small businesses, there are multiple rules, uh, including sales, purchases, and accounts, but there are less staff. Large organization, so many staff involved. As there is a large organization, there are large rules, there are more rules. So consequently, there are more employees also. Retail shop, so really less employees. There may be some sales assistants and things like that. So management. So here, the key personnel in the rules in this area, we will be also covering that senior manager must authorize larger expenditure and oversee financial controls. So no low level or junior employee should be able to authorize or order big expenditure and incur big expenditure. Control over transactions. You know, uh, employees are somehow the agents of an organization. So, in order to have a control over the transaction and control over their integrity, so there should be internal controls. So, what are those controls? Uh, there are numerous forms of it. One is authorization, that only staffs with the permission must be able to enter to a specific transaction. Like what? Like only the sales assistants are there to make sales. Reconciliations. Reconciliation means matching the record with the actual balances, like the petty cash. You go and count the cash, and you also go to see the vouchers that how much has been expense or how much it is being spent. Error prevention procedures and checks reduce mistakes in sales, purchase, purchases, and payments. There must be some procedures that are to be met or are to be done in order to prevent errors. Fraud control, there should be internal controls and checks and authorization checks to protect against theft and fraud. So, an employee, a junior employee, must be not be in a position that he orders and incurs big expenditure. Timing of transaction. Timing of transaction. It really is a point that some transactions are incurred frequently and some aren't. How? So there may be, if you look at sales, it's a daily transaction. The frequency is much higher. But we look at a more or less frequent transaction that it would be a payroll. It's made the payroll expenses or the payments to employees. It's made on a monthly basis. But if you go to see the acquisition of equipments, it's less more frequent. It's more or less frequent. So transaction vary in frequency: daily sales, monthly payroll, quarterly bills, and occasional asset purchases. So prompt regarding ensures accounts are current for management owners and tax authorities, providing a true and fair value view of the financial position. So whatever the timing of the transaction is, it should be accurately recorded in the books of the account, in the books and accounts of the businesses, in order to show a true and fair value of the financial position of the business. So, with this, we are coming to conclusion of this first chapter. So, I really highly recommend that you go to Kaplan book first, and you revise the entire chapter, and then you are going to work those exam style questions in the Kaplan book. So, if you really find this video helpful, try to hit that like button, subscribe not to miss, and we will be covering in next video we will be covering chapter number 2.